I want to finish today, guys, talking about the future a little bit. The future of rates, the future of the economy, and the future of the Fed. My favorite people. Not really, but I don't hate the Fed.
But you know what, Andy? This time around at this meeting, it was Uncle Powell. It was just, I don't know. He just seemed to be more at ease.
It was more
optimistic this time around. It felt like, all right, I think we're going somewhere.
You know what I noticed? He didn't feel wound up.
Yeah,
like,
it was tight.
But here's the thing. Like, when I used to watch and listen in like 22, 23, 24 even, I'm like, okay, he was kind of like the same. It was like this very linear, neutral, but now you watch him like last week and then you see the comparison. I'm like, oh, that bro was wound tight.
Dude,
that bro was wound real tight.
His pizzazz is growing, bro.
You know, he didn't feel so like, I can't answer that question, right? Like, he just felt like we have a solution. We're going to work towards this. Like, he seemed a lot, like his shoulders, it just seemed like a lot calmer. That's what I took.
Oh, yeah. The posture was completely different. The tone.
Very different.
The optimism. And I know they're not going to say, oh, we're optimistic, like that overtly, but
the connotation of the words that they said gives off a more positive feeling. Like,
100%.
Oh, okay. Like, they're using words that aren't like, relative to regular people, and they aren't positive, but they give off a better vibe that it's in a better direction, instead of it being like, oh, why did he say that? What did he mean by that? It's like, okay, yeah, that makes sense. Okay, yeah.
That's what it seemed like. Like,
it felt
better.
Observation.
It felt like we're moving in the right direction. There are going to be some hurdles, just like anything. Change comes with hurdles.
Yeah.
Change comes with uncertainty of what's going to happen. Change could come with successes. It can come with failures, and that's what we're going to figure out. And I just feel like the way he came about things was just like, we're going to figure this out, and we're looking at bringing down rates. I don't know yet, but that's in the horizon. So that gives a lot of puts things in perspective, like, okay, all right, let's adjust.
So I want to let you know that this was a very intentional inclusion in this week's show, because we're talking about inventory. We're talking about 2 episodes, how 90% of the people surveyed don't want to list their home or are fearful of selling. And then now you have February pending sales are higher than they were in January. Yeah. January was slow. What is this comeback happening? Here's the best time to sell in the spring. This all lines up. Think about, whenever we're talking about vertical integration off camera.
Yeah.
This all vertically integrates with, the Fed's posture and what they think is on the horizon, even though they can't totally telegraph it. Their dot plot chart, I'll show you in a second, kind of telegraphs it. Yeah. Their comments say, okay, that storm that we were in is kind of behind us. They're not saying that exactly, but they're totally inferring that in their comments and the way that they're saying things. And I think that's why this is going to have a cyclical effect.
Yeah.
It's like we're telling people they should be selling in the spring. We're telling people that, February pending home sales is up. We're telling people that rates are kind of good and they're going to only get better. And that's only going to feed that system to, guess what? Come bring up the economy again, because mortgage and real estate is a multi-billion-dollar annual business.
I'm sorry.
No, I was just going to say, I definitely agree that the sentiment has changed.
Yeah, and for me, it was like, last September, what did we hear about? How many jobs were created?
Are you talking about the miss? 880,000.
You know what I mean? And so I felt like at that time they had to fluff things so that people wouldn't be so scared, fearful. This time around they came up and they're saying, like, for instance, our change in GDP, right, we wanted 1.7. And so now it'll be 2.1. I think what they're saying is, I'm just going to not fluff it and exaggerate things. I'm going to go to what's going to be more realistic.
Yeah.
People may not like what's to hear that, but this is going to be more realistic instead of us fluffing 880,000 jobs.
Yeah, overstating 880,000 jobs was a huge data miss.
Right, and then they go from unemployment 4.4, now they're saying projected by December it's 4.3.
And okay, I'm glad you said this. You don't know I'm going to say this. Here it comes, guys. Here's what's so interesting about that, and I thought about this, is if there's so many millions of people being cut off of the payroll from all these government agency jobs they have, shouldn't that show up in the unemployment number somewhere?
Absolutely.
Okay, so then I want to see that. I absolutely want to see if that's. I'm not saying I want to see destruction. I'm saying I want to see the numbers show up.
Yeah.
Because it's going to tell us 2 things. That's millions of jobs that are actually there that people have lost and they have to receive unemployment benefits as a result of. If we cut millions of jobs that actually didn't exist, then that number is going to stay consistent, thus verifying those jobs actually didn't exist. Yeah. So this is the most intriguing part of the next 60, 90 days for me, is let's see what happens. Millions of jobs are getting cut.
It's crazy. You speaking about jobs, I saw Pulte. He's a director. Polte. And so he went to the Fannie Mae, to their headquarters. And you're talking about this building is ginormous. So they have to have like 2,900 people that work right there. And only like 200 some people showed up. And it was the janitors and the cafeteria people. Everything else was just like empty. We're renting all this space that costs millions of dollars.
Where they at?
And where they're at.
Work from home?
Exactly.
Work from home or don't exist. And that's the kind of the argument that's being made. And I'm not going to get into arguments with people about that. They're either telling the truth about it or they're not, okay? Is the bottom line. So I'm not going to get into the weeds about all that.
Because we're not there, right? I mean, you're going to believe what you're going to believe with the data that's been provided.
Right.
You know, again, if you can prove it otherwise, go ahead. I'm okay with it. I'm a big believer that these things do exist, and there's a reason why there's a cleanup crew right now.
I ultimately think it's going to come down to just the black and white nature of some things, because either you're saying these jobs exist and we're cutting them, and that's going to show up somewhere else in the downline of the data, or these jobs don't exist, it's not real people, and it's going to be the same unemployment rate as you saw month after month after month. That's kind of part A. I think also the other part, you can see who's going to bluff. Who is the White House going to bluff first, or is the Fed going to bluff first? Someone's going to flinch or blink an eye or something because the White House wants our economy to go in this certain direction. They think the way is with tariffs. The Fed is saying, hey, we got to keep inflation kind of under check. It was at like 9.1% 3 years ago. Now it's down to the 2s and 3. Okay, well, again, I'm going to say it's slower, not lower, because there's still no negative handle in front of that number. But I think it's going to also come down to being very delicate, because the amount and the vastness of change is extraordinary.
Yeah.
And you have to be now very delicate in your next couple of moves, so that if there's a lot of this stuff tinkering and let's say the whole China shop is at an earthquake, well, which pieces you're going to put your hands on and which shelves you're going to hold on to, which ones you're going to just kind of let go, because you can't save everything, right? You see where I'm going with my illustration? So I'm very curious to see who's going to call who's bluff first. But the reason I'm going so long on this is because they specifically mention mortgage rates and the bond yield, which we talk about all the time. So the Fed's decision, the economics and the data that's supporting the Fed's decision, and then how the markets react is what is being said here, and which we know is a critical factor in what the forecast for 2025 and I'll say 2026 looks like for the economy at large. Yeah, it's connected to too many things and too many people for it not to be. Any other thoughts about that?
No, 100%.
No, thank you for coming to my TED Talk.
Yeah. No, 100%. I mean, again, I'm just going to go back to, them setting the expectations where we were pushing things to go, pushing them to meet those quotas essentially right away. Now they're being more realistic. Like, based on everything that's happening, we're not going to meet that. We're going to have to increase this and be a lot more realistic with these matters.
Yeah, and I think some of that that I'll say truing up is going to take a while. And can I use another illustration?
Please.
So when you bake a cake, there's like flour, and then there's like the egg, and there's water. You got to mix it, whatever. So some of the things, like you mentioned the $880,000 jobs overstatement, like that's just way too much sugar in the cake mix.
Yeah.
Well, I can't undo that cake. Now I found out after it's all baked in, oh, there's way too much sugar in that recipe. I can't go undo that. But now that I know, and I'll use the right recipe moving forward, the cakes are going to look different.
Yeah.
And so there's some of these things that are, to make the pun full circle, they're baked in. So some things are baked in, and they're going to look really bad on the data part, because you're like, oh, wow, massive contraction of jobs and expansion of the workforce. Well, hold on. We just chopped off a huge limb of this tree. Okay. So just take note of that, be aware of that, and don't let the statistics draw you by the neck into the slaughterhouse.
No, totally. As a matter of fact, I wouldn't really want to watch the Fed meetings. I would be like dreading it. Like, I don't want to watch that thing. It's going to see the same crap already.
I like watching just the clips.
Well, yeah, but what?
But this time it's like, it's kind of like, oh. You know what? I'll watch it next time. I'm curious to see what the demeanor is going to be. How is he going to answer the following questions again? Like, is he going to be a lot more relaxed like he was this last time? Or is he going to go back to that tensed up? And how do I have to kind of circumvent the question into
Yeah. And I think it's going to be really interesting to see what materializes in the Fed's dot plot chart. So I brought this to show you guys because of what you're saying. To see how they had the Trump administration, then they had the Biden administration. Now they got Trump administration part 2. And now having seen that fluidly from the beginning to end, this is going to be a really interesting snapshot in time of the history of the Fed. But on your screen for everybody here, guys, is the 2023 and 2024 Fed, what they call the dot plot chart. And this is the last thing I wanted to bring up today, is that in 2023, you see that a lot of the Fed numbers were guessing that by 2025, we'd have most of the rate. Everyone thought mostly would be between 3% and 4% on the Fed rate. And then when you ask them again in 2024, you have about the same amount in that 3 to 4% range, but a lot in that high 2, low 3s. So as time has progressed, you can see that their opinion on where rates are going is down.
Yes.
Which is going to hopefully land us somewhere in 2025 and the beginning of 2026 in a much more, let's say, safer, stabilized long-term zone, now that all the curing they had to do is over because of the high rates they had to ramp to and hold them.
Yeah,
that's my take.
And I'm going to say it's going to be 2026 where we'll start seeing that.
Agree. Yeah, I agree with you. I think that we'll start to see at the end of 2025, and then it'll really take hold in 2026.
Yeah,
for
right
sure.
now for me, it's all about save whatever you can. Just save, be frugal. Just don't make purchases based on wants. It's got to be a need. If it's a want, throw that away. There'll be a better time for that later down the line. For now, position yourself better so that you can take advantage of the opportunities when they present themselves.
Yep. How about you, Brian?
I think that, I'm curious to see what 2022 looked like, because then at the end of that, basically in 2025, everything's leading for it to come down. So what do you think as far as, knowing this information for the regular people out there, what do you think that's going to do for the market, knowing that things are on the way down? What advice would you guys give to anybody like that knows this and wants to get in the market maybe in these next 6 months?
In the real estate market or the financial markets?
In the real estate market and financial markets.
So I have two competing thoughts. They're not in any particular order. The first one is get your house ready now. Mm-hmm. So if you're looking to buy a house in 2025 or 2026, start that process right now. Because if it's true that prices are not going to go anywhere, but the cost of borrowing might go down, then that is a huge way for you to kind of know and forecast for yourself and pace yourself into home ownership. If you're already paying rent in an area that's equivalent to what home ownership costs would be, then you are the prime person to be able to get qualified and also find a house. If inventory comes up, prices stay the same, but borrowing costs go down, that is the formula. That's my short code formula for, hey, get a house. Exactly. The second thing is what you're talking about. And you've talked about time and time again. Get a budget, make a budget, follow it, pay off what you can, save everything else, and invest part, because it's about time in the market, not timing of the market. So if you're in your 20s, you're in your early 30s, start putting money away now. Even if the market has a correction in the financial markets of 20%, 30%, but you're dollar cost averaging and you don't need that money, then you can afford to let it ride for 5, 10, 15, 20, 25 years. Mm-hmm. And anytime you do a 20-year, 30-year look back, guess what? Everything's always much higher when you look back for that long period of time. So those are my two thoughts.
No, great advice. I think, pay attention to the long term of what you're going to do. Getting into a home, preparing yourself right now. Yeah, if things are tighter right now, just little by little, figure out how am I going to pay certain credit cards or certain loans off right now, if that's what you have it. Because a lot of times that prevents you from making that decision of, let me just jump into this big investment, And so what you have to do is just focus on the smaller things, which is those little credit cards, take those out of the way. Create a habit that's going to help you just break through that old habit of spending, and I'm going to pay it later. Yeah. Instead, just try to hammer those away. Don't go spending. Download those value meal freaking apps, McDonald's, whatever. Stick to whatever you have to do. But the whole idea and the whole goal is just don't go on the spending sprees. Save that. Put that money away, or if you have money in the bank account, go and do an APY account somewhere. Just Google APY and a percentage yield, and that's going to pay you a lot more than just having your money in the bank account, where you're earning nothing. These APYs will pay you anywhere from 4 all the way to like 6%.
Yeah.
Right now banks are in need of your money, so go invest it where they need your money, where they're going to give you a better rate of return on that investment. So that's another place to put that asset to help you. Just, hey, you know what? I have $100,000. It's going to earn $5,000-$6,000 at the end of the year, where it was earning nothing. That can help me pay off a credit card later down the line, or it's just going to help me for that down payment later. Mm-hmm. So focus on the long term, right? if I can do this now, short term, pay off this debt so that long term I can get into a potential investment that's going to be for my children. And when the rates start going down, you start affording a bigger, larger home for that growing family. Perfect place to put yourself in.
Yeah, that's good advice, especially if you can afford to like park the money for the time they want you there, 6 months, 9 months, or 12, or whatever it is, depending on the yield and the time they need. If you can afford to do that, that's a great way to kind of cut inflation off at the pass and then get yourself a little bit of return just for being okay separating yourself from money that you don't really need actively every single week and every month. So that's a great idea.
And not going into a CD either. You know what I mean? Right. These things are just like a regular checking account.
Yeah, so. Awesome.